You're listening to Indications by the Conference Board.
Hello, my name is Klaas de Vries. I'm an economist with the Conference Board, and it's a pleasure to welcome you to this edition of Indications Podcast, a series brought to you by the Conference Board. Today, I will be sitting down with my colleague Ilaria Maselli and Frank Heemskerk from the ERT, the European Roundtable for Industry. And we'll be discussing some of the insights from our recent work regarding, for example, the European outlook for 2022 and beyond, regarding the levels of consumer and business confidence that we're seeing. And also, we'll be touching on some of the key risks relating to the outlook, in particular inflation. So, Ilaria and Frank, welcome to the show. How are you today?
Good. Thank you, Klaas, for having me.
Yes, also here, very good. Good to be back on the show. Looking forward to it.
Great. Thanks for joining. So let's start with some of the fresh data on the Conference Board measure of CEO confidence for Europe that we published together with the ERT. This is a measure of confidence that we publish twice a year. So the previous release was in June. The latest reading, for the second half of this year, is at 63, down from 77 in June, and it's sort of basically back at the level it was a year ago. And remember, any value above 50 means basically that there's more positive than negative answers. So overall, it seems like there's more positivity among European CEOs than negativity. But Frank, let me invite you to talk a bit more about the results for the second half of the year.
Yes, thanks. Well, first a disclaimer. This survey was taken in October, October 12th to October 27th. So that's before the news of the new Omicron variant, let's say, came out. But the CEOs are still positive. Above 50 is a plus. Cautious, optimistic about the prospects for their own industry, and also, in general, they expect employment to pick up, which is good news, both inside and outside of outside of Europe. So in that sense, a moderately still positive outlook.
Right. So, Ilaria, what did you think of the latest results? What are your comments?
Two things, Klaas. I think it's always useful to look at the US data because we have the same indicators, not biannually, but quarterly in the US. And the data for the US and Europe actually really moved together. They've been going hand in hand since 2020, since we started this project in Europe. For this latest reading, the US measure of confidence was 67, so a little bit higher than Europe, where it was 63. But I think it's just because the survey was a little bit earlier in the US. All in all, I think the message that we get is that conference moderated a bit compared to the previous reading, but all in all, I would say it's still quite high. The other thing that I found interesting in this round is the fact that there is a certain optimism regarding labor markets. It doesn't happen a lot in Europe. And in this round, we found that there is hiring intentions in Europe and outside among CEOs. And on the other side, we also see a more positive outlook for the labor market, also on the consumer side, according to our consumer confidence data from Q3.
Oh, that's indeed an interesting observation, and it seems indeed that labor markets, at least in Europe, have held up relatively well during the pandemic. Despite massive contractions in economic activity. Just to give you some numbers in terms of GDP, in 2020, GDP contracted globally by about 3%. May not sound like much, but it's really the worst performance since the Second World War, basically. And it was much worse in Europe. For example, we had -7% in euro area and -10% in the UK. Now, of course, much of this contraction was concentrated in the first half of the year of last year. And after that, we know a very strong recovery started. So that by the time we will see the 2021 growth figures, they're likely to show a pretty strong rebound. So, for example, we're looking at about 5% for the euro area, about 7% for the UK, and a global average of about 5%. So, but Ilaria, we are nearing the end of 2021. What are we looking for in terms of the outlook for 2022?
Well, class, I think we will be safely above potential for next year, for 2022, and I think also for 2023. I'll come back to that later. So, what we expect for the euro area is a growth rate of about 4%, and in the UK, something like close to 5%. An important driver of this growth that we expect for 2022 is domestic demand. As we said, confidence is high, the labor market is looking good, and there is still a lot of unspent savings in Europe that can support new purchases and new investment. So, all in all, I think the problems are definitely on the supply side, not on the demand side.
Can you elaborate a bit on that? What do you mean by the problems are on the supply side?
So let me explain. So as I said, consumer confidence is good, CEO confidence is good, demand is strong, the labor market is strong, and yet when I talk to our members about the outlook, I really don't get a lot of enthusiasm. I don't get a good feeling, and I think the reason for that is really a lot of supply side constraints that companies are facing. So the first one is definitely the all the problems with supply chains. I don't want to talk too much about it because we all read about the queues in the harbors and the container prices being incredibly high. All I want to say on that is that we should really remember that supply chains are under stress because the demand for goods has been exceptionally high because trade growth is really high. The second supply constraint is equipment shortages. I think is really an important one and not sufficiently discussed. So, at the beginning of each quarter, the European Commission sends a survey to European companies, and they basically ask at manufacturing companies what are the factors limiting your production. And if we look at the results from October, from the latest survey, we see that about half of companies in manufacturing companies in the euro area said that insufficient equipment is a factor limiting production. So this percentage has been going up massively in the last year. It was about 10% a year ago or so. So that's definitely something that is important. And actually, if you look at the responses for Germany only, this percentage goes from 50% to 86%. So basically, nearly all companies, manufacturing companies in Germany, are consider insufficient equipment as a factor limiting production. The other factor is labor. So labor shortages. We know this is a massively discussed topic in the US, and I think we are going to see that increasing more and more as we go into 2022, also in Europe. The percentage of manufacturing companies that say this is a factor limiting production is around 25% right now. So it's not as high as equipment, but that's been again going up since the beginning of the year, and I expect that to go up even further. If you look at labor market data, basically the labor market has recovered almost completely from the pandemic shock. So unemployment in the euro area was 7.5 in January 2020. It went all the way up to 8.6 at the peak around August a year ago, and now it's around 7.4%. So as I said, it doesn't recover 100%, but it's very close to that. And there is shortages that are really felt in countries like in the UK, where there is 1.1 million vacancies open, and in Central and Eastern European countries also. I think this is already felt quite a lot.
Now, Larry, when I hear you talk about these sort of imbalances in demand and supply, I guess they're bound to show up in the inflation data at some point. And I guess, yeah, indeed, when we look at some of the recently released inflation estimate, the latest is for November. It was released yesterday, actually. It showed euro area inflation of about 5%, up from 4% in October. And that's indeed, and this is year over year, and that's indeed the highest rate that we've seen since sort of the start of the common currency zone at around 2000. Now, when we look at core inflation, which sort of strips out some of these more volatile items, We also see an increasing a picture that is increasing. We see 2.5% in November. Not yet a record, but close to a record. It was around 3% in the early 2000s, and again after the global financial crisis in 2008. And this sort of inflation surge has led to a lot of debate, a lot of discussion. It seems in Europe, at least, that the dominant view is that a lot of this inflation rise, surge can be explained by transitory issues, like the ones you mentioned, Laria. They should subside at some point. So they would say, "You look, this is temporary." The question, of course, is how temporary is temporary. And the supporters of this view, I guess they would also point to the experience in East Asian economies, for example, Japan or China, where there's, at least at the moment, still relatively little inflation. And they would argue that is mostly because they didn't have this big disruptions last year or the last year and a half, so to say, the same way as we did here in Europe and also in the US. Now, that is, as I said, that is perhaps the dominant view, at least in continental Europe, still at the moment. But then, on the other hand, you have an increasing, stronger arguments coming from people who say, "Look, this inflation surge is actually likely more permanent than we think." They would point to, inflation is rising in a lot more items. It's not just concentrated in a couple of things. And perhaps more importantly, Laria, you mentioned it already. They would point to rising shortage of workers, especially, as you mentioned, especially the US, the UK, and that, of course, leads to wage inflation, and that could further drive up inflation, and that would really mean the central bank, the monetary policy, would have to respond. Now, overall, it seems like the big major central banks indeed are in a difficult situation. It seems like especially the European Central Bank, the Bank of Japan, they remain very dovish, or more soft on inflation. They argue, we cannot do much about these supply chain related issues. For example, these energy prices, they're set on global markets. We have little direct influence on that. And also, they would point that, especially in Europe, continental Europe, or especially in the southern European economies, they don't want to kill the recovery by raising rates too soon. There are a lot of these economies, even though recovery was strong, they're a long way from sort of a full recovery of all the lost output. Now, the situation in the US seems a bit different, not just regarding inflation rates, which are higher there, but also regarding the overall recovery, I would say, which has been stronger there. And also, there are some signals actually that the economy may be overheating. And we've seen they have started to taper some of their emergency QA programs, monetary easing programs already. They haven't raised rates yet, but the expectation is that will come somewhere in 2020 to somewhere next year. And indeed, I think yesterday the Federal Reserve Chairman Powell indicated that they actually may speed it up a bit more than expected. So, long story short, but obviously this seems to be a big debate currently. And indeed, inflation has been a hot topic now for months. So we actually thought it would be interesting to hear the perspective of European CEOs on this. Now, Frank, can I ask you to invite on this? What did we exactly ask, and what do our results show?
Yes, it's indeed, let's say, a big topic, and it's a challenge, or it's complex for the central bankers to make the judgment call. At the same time, I would say, well, that's their job. That's what they pay for pretty well. And ultimately, when inflation expectations go up, that's also key for them to deal with. As I'm talking about the central bankers. And I'm also happy to hear also that Powell said that, well, maybe we should no longer talk about a temporary hike in inflation, because what is temporary? Keynes said, well, there's temporary and there's long run. In the long run, we're all dead.
Good point.
So if I were them, I would be worried about a loss of credibility if they would be inactive and stay dovish too long while prices go up. What do the CEOs expect, and what came out of our survey? Well, I think it's important to make a distinction that there's a divide. On the one hand, drivers for inflation were seen by the CEOs mainly on the shortage of supplies, the increase in energy prices and transport costs. These may disappear. Trade patterns may become, let's say, more stable next year. Energy prices may go down again. Transport costs may go down. So that's one end. Then on the other end, it's labor market issues. Let's say the wage pressure was limited, but will go up, and also labor shortages. But were still low, but expected to go up. But also there, maybe as a citizen of Europe, that's also a positive thing. If there is a little bit of labor shortages, I'd rather have some labor shortages than huge unemployment. And it also shows that on upskilling and reskilling of current and future labor forces, that pays off. That we need to do a lot, but it also pays off to deal with labor shortages. So let's say a disbalance, clear divide on energy, transport, and supplies. There's a price hike, but that may drop. And then the longer term trend is labor market, challenges on skills, challenges on demography, but it's not necessarily a bad thing, if wages go up a little, if you have a job.
So there actually may be some upside to all this. Indeed, of course, we economists, we tend to focus on the downsides of things. We're known for being the dismal scientists, I guess. Ilaria, do you agree with Frank?
Yeah, I guess the small scientist is why I don't get many invitations for dinner lately. Uh, Now, no, jokes aside. No, I also noticed this divide in the responses. So really, like elements like energy and transport costs, they may normalize during 2022. Half of CEOs tick that box, whereas labor market issues are more expected for the long term. And I think there is a good intuition there, and this has to do, of course, with the demographic pressure in Europe, where in many European countries, actually, there are more senior workers leaving the labor market in the coming years than young ones entering. So I think the expectation is good there.
Now, if I may put on my economist hat on again, so it seems that we can categorize inflation as one of the risks in this short-term outlook. Ilaria, would you agree, or do you see other risks sort of more prominently?
So I see three class, and inflation is definitely one of them. So let me start with this one. I think the problem with inflation is that it can affect consumer confidence and therefore consumer behavior. Where are we there? So in Q3, in our consumer confidence survey, we found that 11% of consumers in the euro area consider rising prices as their top one concern. And this percentage was up compared to a year ago, but all in all, it was in order in historical terms. But if I look more at the periphery of Europe, there is some countries like the Baltic countries, Hungary, Czech Republic, Turkey, where this percentage was more in the range of 20 or 25% of consumer considering this their top one concern. And it also keeps growing. So as I was saying, my fear is that if more households consider this a problem, more people start expecting higher levels of inflation to stay. This will definitely affect their confidence and their spending behavior. The second element, the second risk is, of course, the Omicron variant. I will not say too much on it because I really think we need to understand how infectious this is and how dangerous it is. So I think it's really too early to assess the economic impact. We will definitely come back on this in a couple of weeks. The third risk is the automotive sector in Germany. So if you remember, the sector was already struggling before the pandemic, and now it's in a bit of a perfect storm where there is, a lot of trouble in manufacturing because of the supply chain problems, cost rising, etc., etc. And then there is also technological change happening in all of this. Now, the automotive sector is 3.7% of GDP in Germany, and we know it's a deeply connected sector to other European countries, getting a lot of inputs and supplies from other markets nearby. And if I look at the data for industrial production, I'm really afraid it's going to get worse and therefore affect the whole European economy. Let me give you some numbers there. So if you look at industrial production, and if you take, pre-pandemic industrial production equal to 100, you take the whole manufacturing sector, and it's somewhere around 94 in the latest data that we have for September. But if you look at manufacturing of transport equipment, so more or less cars, this was in September at 69, and it's been going down quite a lot since the beginning of the year. So I think this is a concern, definitely.
Now, Frank, do you agree with Delaria? Do you also see these three risks, or do you think there are other risks more important?
Well, no, I agree with the list of three, but there's a famous quote from the British Prime Minister, Harold Macmillan, when he was asked, what do you fear most? He said, events, dear, events. And that's, so what do you fear most? That are the unexpected surprises.
The
But
black swans.
if I can add one element to it, then it's geopolitics. Of course, that's the unknown, but still, what's going on in Belarus, the tensions between China and the US, the need, I think, for Europe to define its own position, the risks of decoupling. I think the geopolitical mix is risky, but so events, dear events, is are fearful. Yeah.
All right. So we are actually nearing the end of today's conversation. But before we close, I wanted to touch a bit also on some of the longer term, or basically looking a bit beyond the sort of the pandemic mess that we're still in, and look a little bit, into the next decade. A couple of weeks ago, we launched our sort of revised estimates for growth for the next decade, and we did that not just for Europe but also for the global economy. Ilaria, can I invite you to highlight on some of the main results that we got from this?
Yes, sure, class. So let me start with 2023, because as I was saying, for 2022 and 2023, we expect growth to stay above potential. In 2023, somewhere not too far from 2%, probably in the UK and in the euro area. But then after that, what we expect is that growth will return to trend. So what is the trend for Europe? It is somewhere around 1% GDP growth year on year. So what we expect between 2024 and 2031 is an annual growth rate every year of around 1%. Not great, I know. We don't compare well compared to other regions of the world. The global figure is somewhere around 2.5%, just to put things in perspective.
And Frank, just to come to you in this last moment in the discussion, looking at some of the long-term policy issues. I guess the completion of the single market, the European single market for goods and services, that could perhaps be something that can stimulate this growth above the one, sort of 1%
Yeah.
that Ilaria mentioned. But really, how far are we from completion, and what do European CEOs think about this?
Yeah, well, the single market is a little bit like your inbox. It's never completed. You need to work on your inbox every day. But it has been a huge success. The free movement of people, goods, capital, services, has been a very strong driver for growth. But we need to take it to the next level. And as the European Roundtable for Industry, we published a paper where we show, let's say, concrete examples where still value can be created for citizens, for consumers. Let me give you an example. The chairman of Akzo Nobel, Niels Andersen, came up with a story about a single can of paint. And you would hope that in all 27 member states you could sell the similar can of paint. But that's not yet the case. While all the consumers need to be well informed, all the painters, all the workers need to be well protected, all the paint should be produced sustainably, but still various member states have various interpretations. We have a lot of examples where we think member states and commissions together need to stand up, need to do nitty-gritty detailed work. We not only need a vision, we also need, let's say, the technical experts, the plumbers, to work on these differences. Because there was a wonderful piece in The Economist and a couple of months ago, and it said, so if you love coffee, you're flabbergasted that the leading coffee company in the world in terms of also coffee services and coffee restaurants and coffee places is an American. It is Starbucks. It should have been Italian. And I'm not saying it because Ilaria's on the show, but why is the leading global coffee company not an Italian company? Well, there are some explanations to that, but the lack of a well-integrated home European single market, of a stronger home market, is one of the explanations. So if Europe wants to work on open strategic autonomy, if Europe rightly so takes the lead in the Green Deal and the green transition, if Europe needs to deal with digital transformation, one of the key drivers for growth and for value for citizens is continue to strengthen and work on, let's say, fragmentation of our single market. So that's one of the key papers we will produce and which we will share with not only the people in Brussels, but particularly also the various capitals. Yeah, so that's that's a bit of optimism because it's not costly. It is technical work which needs to get the political attention it deserves, but it can be done.
Great, that's good to hear, Frank. We'll be looking out for that paper and indeed for more work to come on that. Unfortunately, we've reached the end of today's discussion. It was very interesting conversation. We went from very high-level topics to very nitty-gritty details, but I think all of it was very interesting. Larry and Frank, let me take this opportunity to thank you for sharing some of your insights in this conversation, and also thank you to you, the audience, for taking the time to listen. Now, if you enjoyed this episode, please remember to subscribe to our Indication podcast series on wherever you get your podcasts from, or you can check out our podcast section on our website, conferenceboard.org. And actually there you can also browse our complete catalog. We have a couple of other interesting podcast series as well for you lined up. Now finally, let me say, if you want more details regarding the CEO confidence measure that we talked about, we have a report available from our website that you can freely download. It highlights the latest numbers and offers a little bit of analysis around it. I'm sure we'll put the link in our show notes. So let me close on that, and thank you again for listening, and see you again next time.
Thank you so much.
This has been Indications from the Conference Board.